Hello everyone. In this video I'm going to continue my discussion about adjusting entries, and we'll focus on the last kind of adjusting entry, which is depreciation. So depreciation is a new concept for most accounting students, especially for this class 1A. What do we mean by depreciation and then how it's conducted? This is going to be our main focus. And then we'll wrap up the adjusting entries, summarize them, and then we'll see some kind of analysis. So fixed assets, or what we call it sometimes plant assets, are physical resources that are owned and used by business and are permanent or have a long life. Example of some of the fixed assets that we should remember from our first chapter is land, buildings, and equipment. So these fixed assets, they are subject to something called depreciation, which is they lose value over time. I think all of the fixed assets lose value except one thing, which is land. So most fixed assets, they lose value over time, except for land. Land is the only asset that doesn't lose value. So as time passes, a fixed asset loses its ability to provide useful service. This decrease in usefulness, we call it depreciation. So all fixed assets except land lose their usefulness and therefore are said to depreciate. As fixed asset depreciates, a portion of its cost should be recorded as an expense. And we call that depreciation expense. And this is some form of periodic expense. We don't really pay it, but it's something that we record as part of our expenses in the income statement. So it's not like really a cash outflow. We don't pay it in the form of cash because we already acquired the asset. But once the assets start losing value, we just record this kind of periodic expense called depreciation expense. So the adjusting entry to record depreciation expense is very similar to adjusting entry for supplies used. The depreciation expense account is increased or debited for the amount of depreciation. However, the fixed asset account is not decreased. We don't credit it, but we do use another account instead of directly reducing the fixed asset account. So we credit an account called accumulated depreciation. And the reason we do that is because the original cost of a fixed asset and the depreciation recorded since its purchase are reported on the balance sheet. So instead, an account entitled accumulated depreciation is increased, or in other words, credited. So what is this account called accumulated depreciation? So accumulated depreciation accounts are called contra accounts or contra asset accounts. The word contra here means opposite. So this is because accumulated depreciation accounts are deducted from their related fixed asset accounts on the balance sheet. So we all know that assets have a debit nature. A contra asset would have a credit nature. Why? Because we subtract it from the related asset. So accumulated depreciation is a contra asset account. We deduct it from its related asset account. So for example, if we have building and we subtract from it accumulated depreciation for the building, that's a contra asset account and it has a credit nature. So the normal balance of a contra account is opposite to the account from which it is deducted. Because the normal balance of a fixed asset account is a debit, the normal balance of an accumulated depreciation account is a credit. So the normal titles for fixed asset accounts and the related contra asset accounts are as follows. And as I said before, land does not have a contra asset account. We don't depreciate it, so we don't have an accumulated depreciation account for it. But for buildings, store equipment, office equipment, you find like we have this kind of contra asset account related to each one of these. It's called the accumulated depreciation dash building, store equipment, or office equipment, depending on the related fixed asset account. So let's see an example that relates to our company, Net Solutions. So Net Solutions office equipment depreciates $50 during December. And by the way, in this case here, they're giving us the amount of depreciation. In a future chapter, we'll see how we're going to calculate the amount of depreciation expense. So in this case, or in this example, we're given $50 to be the depreciation expense. So we simply debit depreciation expense, and remember expenses, they like to be on the debit side, and we credit accumulated depreciation for its related account, which is office equipment, and that's $50 each. This is one of those pretty standard adjusting entries. It would never change. It's always debit depreciation expense, credit accumulated depreciation. And then we have a brief explanation here that says depreciation on office equipment. I want you to see the impact on the accounting equation. As you can see here, depreciation expense went up, and that's why it's on the debit side. Expenses are always recorded on the debit side. They like the debit side. And then on the credit side, we have office equipment, and it's also increasing. Accumulated depreciation for office equipment. Accumulated depreciation for office equipment is a contra asset account. I want you to realize that the office equipment account itself was not affected. So we didn't really do anything to the office equipment. So we want to keep it with its original value. However, we subtract the contra asset account when we present it later on. So the difference between the original cost of the office equipment and the balance in the accumulated depreciation for office equipment account is called the book value. Or sometimes we like to call it the net book value. And it's simply computed as book value of asset, which is equal to cost of the asset minus accumulated depreciation of the asset. So somebody might wonder why we go through this. Why don't we just reduce the asset itself? The reason we don't reduce the asset itself because accountants would always like to show to the users of the financial statements what was the original value of the asset before it got depreciated. But if we reduce it with the amount of the depreciation expense, every time we want to record the depreciation expense, we will never know the original value. But that way, we can always see that we have an original value and how much of this original value has been depreciated. So what is the effect of forgetting to record this adjusting entry for depreciation? In other words, the effect of omitting the adjusting entry for depreciation. If we do that, or if we omit the recording of depreciation expense during an or adjusting entry, you can see that revenue is not affected on the income statement, but expenses would be understated because the amount of depreciation expense would not be recorded. And then net income would be overstated because when expenses are understated, net income would be overstated. On the balance sheet account, or the balance sheet, you can see the asset account would be overstated. And stockholders' equity, because of the overstatement of net income, the amount of stockholders' equity would be also overstated. And nothing would affect liability. So the four things that would be affected would be expenses would be understated, net income would be overstated, assets would be overstated, and stockholders' equity would be overstated. So that was the last kind of adjusting entry we need to learn. So we have four adjusting entries related to accruals and deferrals or prepayments. And then we have the depreciation expense. We have here checkup corner for depreciation. I'll leave that for you to review yourself. I think it's very easy. Now we have just a summary for all the adjustments that we made. And you can see here we have one for the accrued revenue, one for the accrued expense, one for the unearned revenue, one for the prepaid expense, and one for depreciation. I think these two sheets here should be your friend for that chapter because they summarize the main adjustments that are needed for this chapter. So please make sure that you know them, you review them, because they summarize everything that we covered in this chapter. Once we're done with adjusting entry, we just make sure that we record that in the journal. So these adjusting entries are recorded in the journal. And you can see here we have the adjusting entry for the supplies. This is the adjusting entry for the insurance, for the rent revenue, for the fees earned, where we have to record the accounts receivable, for the wages payable, or the accrued wages, which are the employees who work for us, and then finally for depreciation. So this is everything that we've done. And then once we have these recorded in the general journal, we post them to the ledger. And you can see here we have the ledger. Of course, the cash account will not be affected. Nothing affected the cash account because, as I said earlier, adjusting entries do not include cash. That's one of the important rules when it comes to adjusting entries. Never cash. So that's why we never see anything affecting cash when we have the adjusting entries. For accounts receivable, we only had one adjusting entry on December 31st. For the supplies account, we also have one adjusting entry on December 31st. Same thing for prepaid insurance. Nothing affected land. Nothing affected the office equipment. Oh, actually, yeah, the office equipment account itself was not affected, but its accumulated depreciation related account was credited by the $50. Accounts payable is also not affected. Wages payable is affected by the crediting of $250. And then we have the unearned rent, and I hope you remember that. Unearned rent is a liability account, and here we debited it, or in other words, we reduced it from $360 to $240. Common stock was not affected, dividends were not affected, the fees earned was credited by $500, and then the rent revenue was also credited by $120. And then we have a few expenses that were also affected. One of them is the wage expense. We have the supplies expense. Rent expense, in this case, was not affected. Utilities expense are also not affected. Insurance was debited by $200. To be more specific, insurance expense. Depreciation expenses that we just did, $50 on the debit side. And miscellaneous expenses, we have nothing. So now we have our ledger updated. We calculate the new balance, and we take all the balances from each one of these accounts, and we prepare the adjusted trial balance. And this is how it looks like, the adjusted trial balance. It's called now the adjusted trial balance. So remember, in the previous chapter, in chapter 2, we have the unadjusted trial balance. Once we have the adjusting entries, the next step is to prepare the adjusted trial balance. Very similar to what we had before. It's like all the accounts that are in the company with their debit and credit balances, and their total should match. One thing I want you to be very clear about for the trial balance: every account should have either a debit or a credit balance. You can never see an account with both debit and credit filled. It has to be either debit or credit. So we expect all assets to have a debit balance, all liabilities to have a credit balance. Same thing for equity. Dividends is an exception because it's a reduction in equity, so it has a debit balance. Revenues, they have credit. All expenses, they have debit. And again, to verify that everything is fine, the debit and credit should match. So as it says here, after the adjusting entries are posted, an adjusted trial balance is prepared. The adjusted trial balance verifies the quality of the total debit and credit balance before the financial statements are prepared. And that will be the last process. So let me finalize this chapter by going over some kind of analysis. And here we have analysis for decision making, a vertical analysis. So vertical analysis, here we compare each item in the financial statement with the total amount from the same statement. And this is typically referred to as the vertical analysis. Sometimes they call it the standard size financial statement. So vertical analysis is the name that we need to know for this course. So in vertical analysis of a balance sheet, each asset item is stated as a percent of total assets. Each liability and stockholders' equity item is stated as a percent of total liabilities and stockholders' equity. In vertical analysis of an income statement, each item is stated as a percent of the largest value, which is revenue or fees earned. So let's see an example. So here we have an example for an income statement comparing year 1 and year 2. And you can see that the values or the amounts have been converted to percentages. So how we calculate 6.7, for example, which is the percentage for utilities expense. We get the 12,500, which is the value for utilities expense, and we divide it by fees earned, which is the largest value on the income statement, and multiply by 100, and that would be 6.7. And you can apply this to every single value. You can tell this is very useful for businesses because I can compare previous year percentages to the current year percentages. So you can look at year 1, it's 45,000 for wages expense, and for wages expense in year 2, it's 60. You can see there is a 15,000 increase, but it's only 2% increase relative to the fees earned. Something else would be, it was 12,000 for rent expense, now it's 15,000. But percentage-wise, it's still the same. Okay? Another good thing about using this kind of vertical analysis, it tells you like what is the biggest percentage that was spent or the expense that we have compared to our fees earned. You can see that wages is the biggest percentage in terms of, or compared to our fees earned. And that 50% of our fees earned goes to net income, and this is a good thing. However, last year was a little bit better, it was 52.8%. So that's the benefit of using this kind of vertical analysis. You can compare the numbers with referring to some kind of other base. And in this case, it's the fees earned. So by that, we can also see the operating income statement, or like another percentage compared here, which is the sales and marketing. Like this is the 28.2%. How did we get it? You can see here that the sales and marketing was $169,000 and $5. If you divide it by 600,000, which is the value of total revenues, and in this case, it's about 28.2%. So this is another way of applying the vertical analysis for an income statement. So by that, I conclude my discussions for Chapter 3. I wish you all best of luck. Let me know if you have any questions. And I'm sure this is going to be easy based on some practice. Please make sure that you work on the homework. Don't fall behind, because falling behind is the biggest problem when it comes to accounting. So keep yourself on track, and that should be very easy. So good luck, everyone, and I'll see you next week.